In response to the global challenge of climate change, we continue to find improvements in both our energy use intensities and our emission reductions. We have reduced our energy intensity by 10% since 2016. We've reduced our greenhouse gas emissions by 7% over the same period. And we've now set ourselves 2030 targets to improve energy efficiencies and to reduce absolute greenhouse gas emissions by 30%, as I mentioned, by 2030, and that's off a 2016 baseline. A large enabler of this significant reduction is the introduction of hydrogen fuel cell mining trucks. These trucks will utilize green hydrogen generated from solar PV farms and will have zero carbon emissions. We're on track to trial the first hydrogen fuel cell truck at Mogalakwena in the second half of this year. The business delivered a steady operational performance. Own mine production was stable, up by 1% year on year. However, it is worth noting that we had record performances again from Mogalakwena and Unki mines, up 4% and 5% respectively. This performance is despite a number of headwinds that occurred in 2019, the first of which obviously was, no surprise, was from the Eskom power disruptions, which resulted in 38,000 ounces of PGM mining production lost. We had maintenance on a cracked mill at Mogalakwena, the unprotected strike at Mototolo, and then also a complete rebuild of the rope shovel at Mogalakwena. Refined production, which excludes the tolling and refining of 4E material that was previously POC, and of course that material we give back to the third parties. Refining performance increased 11% year on year due to the strong processing performance, in particular in the second half of the year. And this was despite the power outages that disrupted the process operations, which led to 89,000 PGM ounces disruption that'll flow over into 2020. The all-in sustaining cost for the company reduced to $293 per platinum ounce sold. That compares to a platinum price of $861 per ounce. Mogalakwena continues to deliver and has had another record performance, as I mentioned a bit earlier, producing 1.2 million PGM ounces, an increase of 4% year on year. This was despite the shutdown for maintenance on the cracked secondary mill at the North Concentrator and a significant rebuild of the rope shovel. Going into 2020, greater mining equipment availability, the purchase of additional trucks, and the mining of ore that has already been exposed will result in greater mining performance for 2020. Despite these headwinds, Mogalakwena had the best EBITDA margin in the portfolio of 56% and a ROCE of 55%. The mine generated 9.9 billion rand of economic free cash flow at a negative all-in sustaining cost of $429 per platinum ounce sold, highlighting just the benefit of the basket of metals that we mine at Mogalakwena. And then finally, we completed the purchase of the Kwanda and Central mining blocks. Previously, those were exploration rights that are contiguous to Mogalakwena. These have been subsequently incorporated into the Mogalakwena mining right, effectively doubling the Mogalakwena mining right area. And you can see just pictorially what that looks like on slide 65 a bit later. Amandelbult is a mine in transition and delivered PGM production of 893,000 PGM ounces, an annual increase of 3%. The mine had a difficult Q1 which affected the first half performance, but I'm very pleased to say that the mine had a much better second half, with production up 12% on the first half, as both immediately available and immediately stoppable reserves have been increasing, and we're now starting to see a much greater production performance from Dishaba Lower. The chrome plant capacity was again expanded through the Merensky concentrator this past year, where we constructed a further 2 chrome modules, which were commissioned in the third quarter, and this will result in an incremental 340,000 tons of chrome produced per annum. Amandelbult's EBITDA margin increased to 30%, with a return on capital employed of 49%. The mine generated economic free cash flow of 3.3 billion rand at an all-in sustaining cost of $390 per platinum ounce sold, and in the case of Amandelbult, particularly benefiting from its high rhodium content. Unki mine, as I mentioned earlier, delivered a record production performance. PGM production was up by 5% year on year to 202,000 PGM ounces, as underground mining efficiencies have improved, as well as concentrator throughput grade, higher grade and higher recoveries. The mine delivered an EBITDA margin of 35% and a ROCE of 24%. Economic free cash flow of 1.1 billion rand due to their strong performance at an all-in sustaining cost of $88 per platinum ounce sold. And again, in the case of Unki, demonstrating too their mix of metals that they produce. And then perhaps just a final comment on Unki, that despite the challenging macroeconomic environment in Zimbabwe, Unki continues to deliver. So refined production, which shows the charts on the left-hand side, you can see increased by 11% on a like-for-like basis due to strong operational performances, again, as I mentioned, particularly so in the second half. And this was despite being impacted by power outages, which led to a temporary build-up of work-in-progress inventory, again, as I mentioned earlier, of 89,000 PGM ounces. And that increase in inventory should largely be refined in 2020. Sales volumes, depicted by the graphs on the right-hand side, decreased by 1%. But it increased by 7% platinum volumes and 13% for palladium volumes. And that is, of course, on the back of increased refining production. Total PGM sales were down, however, by that 1%, largely as a result of minor metal sales that reverted to more normalized levels after a year of very strong sales in 2018, where we not only sold all of our production, but we also sold down stock of minor metals that we had.